India's September quarter GDP for FY26 delivered a surprising 8.2% growth, exceeding expectations and improving on the 7.8% recorded in Q1. This strong performance comes at a time when October's trade data revealed a historic deficit of $41.68 billion, partly due to a sharp rise in bullion imports, an indicator of underlying economic uncertainty. The growth momentum appears broad-based, with manufacturing expanding by 9.1% and services by 9.2%. A key positive is the revival in private consumption, with private final consumption expenditure rising 7.9% in Q2 FY26 compared to 6.4% a year earlier. Government spending has also played a supportive role. Together, these trends suggest domestic economic activity has remained resilient despite global volatility. However, there are important caveats. The U.S.'s two-stage tariff system on Indian goods came into effect mid-quarter, and some export orders may have been rushed ahead of the tariff hike, artificially boosting Q2 numbers. Another statistical factor is the unusually low retail inflation of 0.25% in October, which pushed the GDP deflator below 1%. Such a low deflator mechanically raises real GDP relative to nominal GDP, as seen in the narrow difference between nominal growth 8.7% and real growth 8.2%. If inflation rises or oil prices increase, especially as India diversifies away from discounted Russian crude, real GDP growth may moderate. The RBI's upcoming MPC meeting could further shape demand dynamics through policy rate decisions. Sectoral data adds more nuance. Construction grew at 7.2%, while financial, real estate and professional services surged by 10.2%. Reflecting strong performance in capital-intensive sectors. Industrial data supports this. September's IP rose 4%, with steel and cement showing robust growth. This aligns with the 3 repo rate cuts earlier this year, bringing the policy rate down to 5.5% and likely stimulating investment. Yet, growth remains uneven. High-skill, formal sectors such as banking and technology are driving much of the expansion, while labor-intensive, export-linked industries continue to struggle. Rural consumption indicators remain weak, signaling persistent demand-side stress at the bottom of the pyramid. While India's growth numbers offer room for cautious optimism, the concentration of growth in formal and capital-heavy sectors, alongside widening trade deficits and external uncertainties, suggests that sustaining this pace may prove challenging in the coming quarters.